Hello friends, welcome to Healthy Savings. Today we will discuss about the mutual funds. So why do we need mutual funds or why we want to invest in the stock market through mutual funds? So in order to grow your money, in order to meet the rate of inflation. So in order to grow your money, you need to invest in instruments which can give you returns at least more than the inflation rate. So if the inflation is around 7 to 8%, while interest bearing instruments like FD, which can only give you 5 to 6% maximum interest, so your money will not be able to meet the inflation rate. So there will be no growth of the money. So stock market gives you an opportunity to invest and beat the rate of inflation while growing your money. But the question is how? As there are large instruments available and investors don't know where to invest and when to invest. Also, some people want to invest small amount every month and some want to invest large amount in one go. And the main problem is most investors do not have the enough time to understand the stock market because stock market investment needs good financial knowledge. So you might need good financial advisor who can look after your investments, but that too comes with an additional cost. So most of the people do not want to spend money on taking the services of the financial advisor, and some cannot afford the services of the personal financial advisor. So the solution for all this is mutual funds. So mutual funds provides you the benefit of flexible investing in the market instruments while enjoying the professional management of your portfolio. Also, mutual fund invest in diversified stocks, bonds, etc. So it lowers your risk on investment. Moreover, mutual funds works as per SEBI norms. So mutual funds brings you the affordability so that if you want to invest in small amount every month, you can with an option to easily redeem your mutual fund when you need money. However, taxes and redeeming fee will be applicable depending on your investment period and scheme. So mutual funds are managed by the fund managers and they are professional and expert in the field of stock market, and they are the ones who invest in the stock market on your behalf. So let's move forward and see more details about the mutual funds. So mutual fund is a trust with the sponsors, trustees, asset management company and the custodian approved by SEBI. So what does these words mean? Sponsor, trustees, AMC and custodian. So basically, a sponsor of the fund creates a mutual fund trust and sets up the AMC. So, a sponsor is responsible for the registration of the mutual fund and the appointment of the trustees. So, what does trustee do? They oversee the running of the AMC and ensure the compliance with the SEBI norms. And trustees appoint the AMC who do the management of the funds, that is buying and selling of the securities. Custodian keeps an account of all investments of the mutual fund. So they have to work in compliance with the SEBI norms. Large number of investors pooling their money with common investment objective. So what does it mean? It simply means mutual fund collects money from the investors and pools the money and then invest the money in the stock market based on respective investment objective. So what is investment objective? So the investment of the mutual fund is always based on a theme which is defined in scheme investment document, which is also known as SID. So investment objective or scheme investment document defines how and where the money of the investor will be invested, that is in bonds, equities, debt funds, etc. So large cap mutual funds invest in the large cap companies only, and if you read the scheme investment document carefully, so you know where your money is being invested by the mutual fund house. Some people think that the investment in the mutual fund means investment in the stock market, but that is not true, as mutual funds also invest in the debt instruments. So if you are a conservative investor and you have a low risk appetite, then you can choose a mutual fund which can invest in debentures, bonds, or in government securities. The risk is lower in debt instruments. For that, you need to read the scheme investment document, and you have to identify the mutual fund in which you want to invest based on your risk appetite and end objective. So let's see how scheme investment document looks like. Type in the name of the mutual fund, Access Blue Chip Fund Investment Objective. So the name suggests blue chip fund means it invests in the blue chip companies only. But then also we will see the investment objective of this fund. So if you go down, you will find Access Blue Chip Fund SID. So if I click on this PDF document will open and it displays the information about the mutual fund. So if you see, the name of the mutual fund is Access Mutual Fund. Asset management company is Axis Asset Management Company Limited. We have already seen AMC. We already know what trustee do. We already know what the sponsor do. So trustee is Axis Mutual Fund Trustee Limited, and the name of the sponsor is Axis Bank Limited. It also says this product is suitable for investors who are seeking capital appreciation over long term. Investment in a diversified portfolio predominantly consisting of equity and equity related instruments of large cap companies. That means this particular mutual fund invest in the large cap companies only. So investor understand that their principal will be at a very high risk. So if you want to invest for a long term, you can choose the mutual fund according to your requirement. If we move further down, we will see investment objective to achieve a long term capital appreciation by investing in a diversified portfolio predominantly consists of equity and equity related securities of large cap companies and derivatives. However, there can be no assurance that the investment objective of the scheme will be achieved. So minimum application amount is rupees 5,000, and in multiples of rupee 1 thereafter, minimum additional purchase amount is rupees 100. So you have two plans, Access Blue Chip regular plan and Access Blue Chip direct plan. So what is the difference between the regular plan and the direct plan? We will see it on later. I have already mentioned it on a slide. What does direct and regular plan mean, and which is better for you? Entry load and exit load. So we will take a look on these things again. First, we will see what does entry load, exit load, direct plan, all these terms mean. They also said risk factors. Then, so it's a base. This is the whole document which explains everything about the mutual fund, where they invest. They also say how will the scheme allocate assets, equity and equity related instruments of large cap companies, minimum 80, maximum 80, 100. So this is how scheme investment document defines the investment objective of the mutual fund, and based on the investment objective, you can choose the mutual fund which best suits you based on your risk appetite, based on your term of investment, based on your end objective. So mutual funds are managed by fund managers. So we have already seen fund managers are the professionals and the expert in the field of the stock market, and they are responsible for investing in the stock market on your behalf. Income generated is distributed proportionally among all investors. So what does it mean? So when fund managers invest your money in the market, you get the NAVs allotted based on your investment amount. So what does NAVs means? It's basically net asset value. NAV is a unit price of your mutual fund, and if I want to take an example, NAV is basically a unit price. Similarly, we have 1 rupee, we have 100 rupees. So 100 rupees composed of 100 1 rupee. Similarly, we have NAVs in case of mutual funds. For example, if you have invested 5,000 rupees in mutual fund, and the NAV is 50 rupees. It means 1 unit of mutual fund cost you 50 rupees. So, how many units will be allocated? Number of units allocated will be equal to 5000 divided by 50, which comes 100 units. So, when you invest 5000 rupees, you will get 100 units of NAV in the mutual fund. And using NAVs, you can track your investment. For example, currently the NAV is 50 rupees, and after 1 year, it goes to 60 rupees. That means 20% growth. So, if your NAV goes from 50 to 60, it simply means your investment of 5000 grows to 6000 rupees. So, this is how you can track your investment also. Mutual funds can be shortlisted based on investors' requirement by checking the SID on the AMC website. So, we have already seen the scheme investment document. The scheme investment document contains the full information about the mutual fund, and it has some terminologies. We are going to take a look on all the terminologies in a bit. Mutual funds can be equity based, debt based, and tax saving based also. So there are different types of mutual funds available: equity, debt, hybrid, tax saving, which are known as ELSS schemes also. So mutual funds can be hybrid also. That means the combination of equity and debt, so that it remains stable, and are also called balanced funds. So based on your requirement, you can also choose a hybrid fund. See, if you have a high risk appetite, you can keep the equity part more you can look for a mutual fund which has more equity exposure. And if you are a conservative investor, you will look to a mutual fund which has more exposure to the debt or gilt or government securities. So, based on your requirement, you have a number of options available in the market to choose a mutual fund. So, there are certain terminologies that we are going to take a look. So, open ended. What does open ended means? That means entry and exit is always open. So, closed ended, where the investment is locked for the specific time. So, when you read the scheme investment document carefully, you will see whether your fund in which you want to invest is it open ended or closed ended. Then you have a direct plan. Direct plan means invest directly with the mutual fund house, reduces the operating cost of the investor. It means if you are investing, if you are purchasing your mutual fund or investing directly with the mutual fund house on their website, by going through, you can log into the website, you can purchase the mutual fund, then it will cost you less. But if you go through a broker, like, we have different stock market brokers with full service broker, they are known as. So they will charge you more. So that comes under the regular plan. Investment through subsidiary brokers increases the operating cost of the investor, as it plan includes the brokerage to the brokerage house. So why you want to pay a brokerage to a brokerage house? It's better you go to a mutual fund website and register directly, and you can invest directly. And the fee what mutual fund charges from its investor is known as the expense ratio. So expense ratio is the annual maintenance charge levied by the mutual funds. So when mutual fund takes, when you invest in a particular mutual fund, so they pool the money and invest in the stock market, or based on their investment objective. So the amount that you are paying to the mutual fund house, they take out a little bit of money from your invested amount, which is basically their professional management charges or the maintenance charges, known as the expense ratio. Entry load, it means expenses incurred for starting investing in mutual fund. It should be nil. So a mutual fund should not charge you for starting an investment in their investment objective, according to their investment objective. Exit load means when you are going for the redemption of the mutual fund, they will charge you something. For example, so equity mutual fund, they say, okay, if you take out the money, if you redeem the mutual fund before 1 year, they will charge you some 1% amount or 2% amount. So in the scheme investment document, everything is written. You just need to know the meaning of these terms so that when you go through the investment document, you know what each word means. Each of these terms mean. SIP. So we always say, okay, start SIP in this particular mutual fund. So what does SIP means? It means systematic investment plan. It enables you to invest on a regular basis and in disciplined manner. Because if you want to invest 5,000 rupees per month in a mutual fund, or 10,000 rupees per month in a particular mutual fund, you can do it. Amount that you are investing every month is known as SIP, systematic investment plan, because you are investing 5,000 rupees or 10,000 rupees or any amount of rupees that you want to invest every month on a regular basis. And it's the affordability that brings that mutual fund house brings to the investors. So even if you have less amount to invest, you have an option to invest and generate returns. SWP is systematic withdrawal plan, enables you to redeem your mutual fund in a disciplined manner or as per your requirement. For example, you have invested in a mutual fund for 15 years or 20 years, and now you want to take out the money, or you want to redeem your mutual fund. So what you can do, either you can take the whole amount, or if you know, okay, my monthly expenses is 1 lakh rupee per month or 2 lakh rupee per month, so I will take out 1 lakh rupee per month or 2 lakh rupee per month, and I will, you know, keep the money in the mutual fund, and I will keep the remaining amount invested in the mutual fund so that it grows. And when I need the money, I am taking it out every month, 1 lakh rupee or 2 lakh rupees, I'm taking it out, and the remaining amount is getting, is being already invested in a mutual fund, and it's growing also. This is known as systematic withdrawal plan. Then you have systematic transfer plan. For example, you have invested in an equity mutual fund at the age of 35, and now you are 55, and you do not want high exposure to the equity. So what you will do, you will transfer the NAVs from the equity mutual fund to the debt mutual fund. So it enables you to transfer from one mutual fund to another mutual fund scheme. Then you have Chrysal. See, when we are going to check, how you can select the best mutual fund. So for that, there is a organization, Chrysal, which gives the rating. And when you want to invest in any mutual fund, so you should check whether the Chrysal rates that mutual fund either 5 stars or 4 star, at least 4 stars. Then only you consider that mutual fund for investment. Then you have AUM, asset under management. So it is the total market value of the investment managed. So if you are going to invest in a mutual fund, check the AUM and select the larger AUM based mutual fund. It will lower your expense ratio. The cost levied by the mutual fund house, annual maintenance charges that mutual fund house takes from its investor. So if the AUM, asset under management, is large, the expense ratio is lower charged by the mutual fund house from their investor. NAV we have already seen, unit price of mutual fund scheme. Then we have different types of mutual funds. So we are not going to into much detail of different types of mutual fund, but yes, we will take a brief look. So equity based mutual funds we have, in which we have different segregation based on large cap, mid cap, small cap, flexible cap, ELSS schemes. Then we have thematic investment also in equity based mutual funds. For example, if you want to invest in the banking sector, if you want to invest in consumption sector, infrastructure, energy, pharma, PSU, MNC, ESG, technology, dividend yield. So these are different, different investment. They have different investment objective. They are different mutual fund based on their each investment objective, and you can invest based on your requirement. For example, if you want to invest, with a higher reward, you need higher rewards, and you have the high risk taking capabilities also. So you can go for the mid cap also, or you can go with the flexi cap. Flexi cap is basically the combination of mid cap, the small cap, and large cap. You can check Okay, in a flexi cap, if I have the more risk appetite, I will choose a mutual fund with large exposure to the small cap companies. If I'm a bit, you know, less, I want less exposure to small cap companies, then I might choose a flexi cap with large exposure to either mid cap companies or large cap companies. Or I am a bit more conservative, then I can choose a large cap companies because I know these are blue chip companies. This is how you need to select your mutual fund based on your risk appetite or end objective and the term in which for which you want to invest. Then you have debt based mutual funds, which are liquid funds, ultra short duration funds, corporate bond funds, long term dynamic bond, gilt funds. So gilt funds basically, invest in the government securities. Liquid funds, they have the maturity of up to 91 days. So these are very short duration funds. They invest in the treasury bills or commercial papers. So these are the interest bearing mutual funds in from where you get the interest, and they are less risky than investing in the equity mutual funds. So those who are conservative, they can invest in the debt mutual funds. Now we have hybrid mutual funds, and in this we have three categories: aggressive, balanced, and conservative. Aggressive hybrid means, see, hybrid mutual fund consists of equity plus debt. So if you increase the debt part, you move from aggressive to conservative. And if you increase the equity part, you move from conservative to aggressive. If you have a mutual fund with more exposure to equity, then it's aggressive mutual fund. And if you are investing in a mutual fund with a high exposure to the debt, then it's a conservative. And if both are in equal quantities, then it's balanced hybrid fund. So it's simple. Now comes the selection of a mutual fund. So how you can select a mutual fund based on your requirement. For that, you need to go to this website, icraanalytics.com. I have already given you the link in the notes available on my website. So if you click on here, so on clicking, you will be directed to this particular website. Over here, you can choose the category: debt, equity, hybrid, other, solution oriented. So if you want to go with the equity mutual fund, you can select equity. Subcategory, you want large cap fund. Type, open ended. Mutual fund name, if you have a trust with some company, you can select, or you can choose that, or you can select all. Growth and submit. So it will show you different mutual fund houses with their same investment objective in the large cap companies. So if I want to, see over here, ICICI Prudential Blue Chip Fund Growth. It has a AUM of 30,956.42. Is the highest among all. No, it's SBI Blue Chip. So these are two mutual funds. And if you see the 5-year returns, the returns of ICICI Prudential Blue Chip is 10.14%. So when we invest in an equity mutual fund, we invest for the long term. So that's why I'm checking the 5 years returns. So it's highest among all. The AUM is large. And if you want to see more details about a particular mutual fund, you need to check some technical parameters, some ratios you have to check, and we are not going in that much detail. So this is how you select. So ICI Prudential Blue Chip Fund Growth, you click on here, so it will show you. It's open ended. This is the average asset size, growth, minimum investment is 100 rupees. Exit load is, if redeemed between 0 to 1 year, exit load is 1%. So now you know all these terms: exit load, fund type, open ended. And then if you go below, top 10 holdings, it will show you the holdings in which this particular fund invests your money: ICICI Bank, SDFC Bank, Infosys, Reliance, Triparty Repo. Bharti Airtel, Axis Bank. Then these are the different ratios. We are not going in much details of these technical ratios. Then AUM movement, financial services, market capitalization, the information they are giving. This is how you can select a mutual fund based on your requirement. You will find the different categories of funds like equity, debt, hybrid. We have already seen those funds. We have selected the equity based mutual fund, large cap funds. So select any one of the fund heading in which you want to invest as per your investment objective and risk appetite. Make sure it should be open ended. So the fund that we have selected is open ended. Then we have to check the entry and exit load. It should be nil. So yes, we are investing for the long term, and the website is saying the exit load will be applicable if we redeem it before 1 year. So it's basically exit load is also zero. Then check the returns over 1, 2 years, etc., based on your period of investment. So if you are investing in a equity based large cap companies, we invest generally for a long term. So I have checked the 5 year returns, and it's highest among all. Check the Crystal rating, it should be 4 and above. So for pricing rating, you can go to Money Control website also. So for checking the Crystal rating, you can go to the moneycontrol.com. You can go to mutual funds, then find fund. So the fund that we have selected is ICICI Prudential Blue Chip Fund. I will go here. I will search this fund. It shows me ICICI Prudential Blue Chip Fund Direct Plan Growth. Its Crystal rating is 5 stars. So there is no question that why I won't invest in this plan. So if you click on this, it will show you the direct plan. So direct plan has the expense ratio of 1.06. Okay. If we go with the regular plan, it has expense ratio of 1.7. See, compare 1.7 with 1.06. It's almost 0.63% higher, and it's a very high cost if you compare it in a long term. It will affect your returns. So that's why it's always suggested to go with the direct plan. 1.06 expense ratio, which is lesser than the regular plan, which is through subsidiary. So this is all you can check on different websites. Then AUM size should be big enough. We have already checked that AUM size of ICICI Prudential mutual fund is larger. People with high risk appetite can invest in equity based mutual funds. The term of investment should be long term. So we have already seen, we have already checked the mutual fund, equity mutual fund, and our term of investment is long. So we have selected large cap company, and we have checked the 5 year returns. Similarly, conservative users can have maximum holdings in the government bonds and other low risk instruments based mutual funds. After selection of a fund, click on it and check the holdings. So we have already seen the holdings. Based on the returns, TRISIL rating, AUM size, and holdings, now you finalize your fund as per your end objective. Do not forget to compare the expense ratio. We have already compared the expense ratio also. Always try to invest in direct plan. It will increase your returns in long term. Yes, we have already done this. So this is from our side, and we really wish you happy savings. Thank you, guys.